Hey everyone, this is Joe Simon. I'm back with episode 8 of the J&J show with my partner.
Josh Yoskosky.
So Josh, here we are, episode 8.
Yes. And we have some carryovers and some follow-up
Yeah.
questions from 7, one of which coincides with, and this is just a topic generally that should realistically be looked at throughout the year.
Mhm.
It should be dynamic. I'll also preface that this is an idea or a process that a lot of advisors shy away from
Yeah.
straight up, because it has to do with purposely realizing
Mhm.
taxes. So a lot of advisors shy away from that. Any time of the year it can be done, but it's something we always look at.
Wait, are you talking about tax loss harvesting?
I am, because
Or-
you never want to waste a good
Yep.
loss.
And you know what? We were remiss in not mentioning this in our last episode of things we do in Q4, because this is one of the things that we do in
Yeah.
Q4.
But that all being said, so tax loss harvesting, there are a lot of different ways to do it.
Yep.
I mean, you could be using options to cause losses, to offset things. You'd be using direct indexing.
But that's more of a full year type of
It is.
strategy or a long-term strategy.
And something that direct indexing, I think, is kind of a buzzword now. People
Yeah.
love to talk about it. It is effectively just harvesting losses, whether purposeful, because sometimes it's on purpose,
Yep.
or harvesting losses you already have while still making return on that
Yeah.
portion. But the only way that I know of to effectively do it to a meaningful extent is you need to have enough cash
That's
to basically meet one-to-one with what
Yeah.
you're trying to harvest.
And we're not gonna do that ourselves. We're gonna outsource that to a specialty firm that's all they do.
Because that is typically a daily trading type of
That is
exercise.
correct.
And there's going to be a cost to that. And it's if the market's down enough on a given day, they're going to harvest losses. And they're
Mhm.
going to harvest losses. And if it's something you're interested in, let us know. There's far more detail than this.
Yeah.
But you can typically still squeak out 80% of market level return on the strategy that's doing the tax loss harvesting, in addition to taking.
Well, I mean, we've actually talked to firms that have said that they can get us market level returns while offsetting, I think in any given year, 7 to 20% of the gains in a year. I think 20 would be max. You'd have to have a lot of cash. But again, with this process, so say you had, $1 million in Apple stock with, let's say 90% of its gains, right? And you want to offset that $1 million in gain, or the 900,000 in gain,
Yep.
where you're going to need to have $900,000 in cash
You
to
should.
offset that whole strategy.
And I think, and you may have to correct me on this, is they really don't want to see you have any less than 25% of what you're trying
Yeah.
to offset.
At a minimum. So again, that's going to be really more of a kind of a specialty kind of, option for, and it's not going to be for every client, but
And it's going to be a satellite type strategy.
yeah.
And as we harvest those gains, the way it typically works is, let's say it was a perfect 50-50.
Mm.
As they harvest gains and raise capital from the pot that we're looking to offset the gains on, that money then goes into the indexing strategy to further accelerate the ability to dwindle down that return.
That's correct. But not for everybody. But, again, if
Yep.
it's something you're interested in, reach out. We can run you through the process, how it works.
Even illustrations.
Yep.
We can tell you if you have X of stock and Y of cash, what do we think we could expect to offset? But to your point, more specialty.
Mhm.
The other area is the more simplistic
Yes.
of, let's look at the tax lots for all the individual positions we have, and where do we have losses?
Yeah.
In taxable accounts.
Yes.
This often comes up, and unfortunately we cannot, believe me, I wish we could as much as anybody. Losses in an IRA are losses in an IRA, really.
Doesn't really matter.
You could talk strategically about how that may fit into an RMD strategy or QCDs or whatever, but realistically, we can't offset losses.
Now, if it's in an IRA, all the dollars are taxable at
Mhm.
your full income tax rate.
So tax loss harvesting is going to apply to non-retirement accounts or potentially trust accounts. So we're going to say something that's non-IRA, non-retirement, non-qualified account, where we go through, and a lot of advisors, as mentioned, don't do this because they're just completely afraid of telling their client, hey, we're going to purposely realize taxes, which is also what we're doing with Roth conversions. But nevertheless, we go through, we look, okay, where do we have losses? Because I do not want to go into a new calendar year with losses on the books for a non-retirement account that we didn't get to use in that existing year.
That is correct.
It's going through, it's at the end of the year purposely harvesting some of the losses. It may be a position we still like where we can find a close alternative so we don't have any issues with buying and selling, or washing, I should say. And also going through, and even if it's a position that we like, but we have losses on hand, selling some
Yeah.
gains so that we have the capital freed up again
Yep.
without tax liability. Now, it is a very personalized subject because you may have already had $100,000 of gain in a given year and there's no losses to harvest, then we just had a very successful year.
Yeah. So what you're saying is that we're going to do this on a case by case
Correct.
basis, and we're going to communicate with the client before realizing any meaningful gain.
Yes, yes, absolutely. We're going to communicate, particularly on taxes. If it's something that we need to make a special approach for, then it's definitively going to be a discussion.
Yep.
I will confess, though, let's say you have $2,000 or $3,000 of losses, and we can get rid of a position that has some gain, but it hasn't performed
Yeah.
really well, and it's going to be a wash to zero tax liability, and it's an advisory account.
Yeah. So if it's a
We're
spread,
going to do
we're
that.
going to do that. Yeah. But if it's going to if it's going to create a meaningful gain for you, yeah, we're going to communicate with you about that.
Yeah. And when we talk about gain, it's the amount of gain we're realizing, but not necessarily what your tax
Yeah.
liability is going to be.
Yes.
So if we say we're realizing $10,000 in gain, that typically is not going to mean that you're having a $10,000 tax liability.
That is confusion. I'm glad you brought that up.
Yes.
Yes.
Yes. And that's something, that just comes down to communication and familiarity with what it's how we explain, because the ball always ends in our court, the buck stops here. But that is something that people kind of throw around interchangeably, that your tax liability and what you may owe versus the amount of gain we're realizing.
And again, we're not tax advisors, but for example, if we realized a $10,000 gain, and you're in the 15% capital gains rate bracket, your tax on that federally be $1,500.
Yep.
And then whatever your state would be, Virginia at 6%.
And you hit another great thing, a logistical thing. We can't pay those or send it on your behalf.
We cannot. It's the only place we can't.
That is something that comes up of, okay, I understand I had a gain. Can
Mhm.
you just send those taxes out? I cannot. What I can do is send you cash equivalent to what some people work closely with their CPA and say,
Yep.
my CPA said I need to do 16% and 6. That's just the number that works for me. Okay, no problem. We'll send you that money
Mhm.
to your bank account. You will then need to go and make the payment if
Yep.
that's the
And we'll also
recommendation.
send you a capital gains report to provide to your accountant
Yep.
to help you figure out that tax liability.
Yep. And that's something, if you want one ad hoc, we can run it for you. If you want them quarterly, we have a list of people that get them
Yep.
quarterly, whether there's a gain or not. Because if you do miss that payment during the time period you ensued the gain, there can be penalties and interest.
Absolutely.
And it's also important that if you make, and we've encountered this more, and this is not our world, this is the tax world, of you made a payment based on those gains, but when your tax return was done, the timing of your payment was not reflected.
Yes. So that's going to be very important. You're going to need to basically make sure that your CPA or tax preparer knows what the payments were and which quarter you paid them in.
Yeah, when you pay them, because we had that issue with a client that came over from another tax prep firm last year to the tax prep firm we like to
Yep.
use, and they credited all of the payments in December of that year,
That's right.
which means they had multiple quarters of penalties and
Yeah.
interest.
And this was based around, a large Roth conversion in which they had a penalty or they paid a penalty of around, I think it was around $6,000
Yeah,
as they didn't need to.
correct.
But luckily our CPA got it corrected and we
Yep.
got those dollars back.
Yep, was able to amend it, and they actually ended up with a slight refund.
Yeah,
But that's a very nuanced and small thing. Some people may say, "Oh, the timing doesn't really matter." It absolutely
it
does.
does.
Again, and particularly to your point
Mhm.
about Roth conversions, if you're, and this is for anything, Roth conversions, realizing gains, say we're going to harvest some losses, but you say, you know what, I don't want this position anymore. Today's the day. Need to know when that realization took
Yep.
place and need to try to make a tax payment very close to that, at least by the deadline for that quarter, because it make a very big difference. And if you're doing your taxes on your own, making sure that you're also
Mm.
reflecting when you made that payment.
Yep.
Because if you did something, say like this year, and maybe we decided to do harvest gains or do a
Mhm.
conversion in the first quarter, and you made a payment in the first quarter that squared you up on what that liability would be, but then when you did your taxes, it was noted that you just did it at the
Yeah.
end of the year. That's completely incorrect.
So, as we approach the end of the year, sometimes we have clients that, we might have a non-retirement account with, a fairly sizable gain. Maybe it's in a brokerage platform, not very diversified,
Yeah.
and we want to diversify that account into, our advisory
Mhm.
platform where,
That's something else.
yeah, something else, whatever it is, right?
Yep.
Or we have another client that maybe, needs to put a roof on their house. It's going to cost $100,000.
Taxable distribution.
Yep, a large taxable distribution, and we're getting towards the end of the year. What's something we might talk to them about?
Yeah. So I think two things come to mind. One is more obvious than the other.
Hmm.
The first one is we split those.
Yep.
They're into 2 calendar years.
Yep.
If we're already in December, then maybe it's a case of doing some now and some in January,
Yep.
2 different tax years. Now you do have to note in that circumstance, that means we're starting that
Yep.
year with a
Yep.
distribution or some sort of
Mhm.
taxable action. So it's changed the whole thing for the
Mhm.
year for us. The other thing you have, and this coincides more with couples that may not be married, is it may make more sense to take that money from one person's accounts versus the
Yep.
others. So these are all various things that come up. Again, it also has to just do with the timing of gains and losses. If we go into the next year, we're then doing it for that
Sure.
year. So that December 31st, why it is such a big deal for us is because that loss is now in a different year. Yes, there's carryover losses, et cetera, but to do it in the most clean way possible, we want to have it take
Yep.
place in the same year. Now, all of this talks about tactically how to do it or
Mhm.
operationally how to do tax loss harvesting. But realistically, I think there's a philosophical side of it of if this isn't ever done along the way through your investment journey, whatever that looks like, you can end up in a circumstance where you effectively have nothing but gain in a position.
Yep.
And if you end up in the environment where you have to use some of that, it is now all gain
Yeah.
that has been at the end.
And we brought in clients from other firms where that's been the case, where we look at a non-retirement account, and again, it's in the same model that's been in for 10 or 12 years, and the advisor had never rebalanced the
The
account, and now,
performance may have been something that was in favor 15 years ago,
yep,
and you're getting below average return.
now, but
Um,
it makes it very difficult to kind of rebalance that into a more optimal portfolio based on where the client is today and what our market outlook is, given the amount of gains that are in that portfolio.
Everyone is different, but what we like to see and what we try to talk about is each year we should have some budget for
Mhm.
realizing gain
Yes.
so that we do not end up in
Yeah.
that position.
Yeah.
It might be something that did exceptionally well 10 years ago and has not done much of anything now, but there's so much gain in it that it's hard to say what we're going to, how you can really go about it without realizing more income or gain.
And it doesn't mean that the client has to pay the tax out of the money they have in their bank account. We're more than happy to send that tax payment from the account
Yeah.
itself.
Let the account that created the gain pay
Pay
the
the
gain.
gain, exactly.
And that's the case for pretty much anything.
Mhm.
I mean, if it's a case of if it's going to be a banknote that realizes gain, we'll happily send that gain.
Yep.
Whatever it happens to be, it only matters to us that it's the appropriate tax treatment.
Yep.
If you have cash on hand, then great, we'll use that. If we're harvesting a security, great. If it's something that was already part of the gain you made and is already in cash, then we'll use that too.
Perfect.
There's no one size fits all, but you should, and we would want you to have a discussion around these positions that are long in the tooth, a lot of gain, are perhaps an overexposure in your portfolio or not really a part of your portfolio, that we have a discussion about some appetite or budget each year of realizing some of the gains.
Perfect. Excellent. Well, I'm glad we had the opportunity to add that to whatever you want to call this episode 7.5 or 8.0 short. That's all the time we have today. With that, like,
Comment.
subscribe. This is episode 8 of the J&J Show. We'll see you next time.